Hello, everyone, and welcome to another one of our video posts. Today, I'm joined by my colleague, Paul Coleman, CFP, here at Level Financial Advisors, and we're going to be talking about the House Ways and Means Committee and a proposed bill that they've released to Congress as of September 13th, which could mean some major changes in the tax code and also several things that investors, and particularly those approaching or in retirement, might be dealing with. So, Paul, let's start right away with this proposed bill that Congress is going to be debating probably for the next several weeks. The responsibly funding our priorities bill. What's in this thing that investors might be concerned about?
Yeah, there's quite a bit in here. I want to focus on what I think could potentially affect some of our clients and primarily retirees, because some of the numbers in here, the income numbers, are huge, and a lot of people may watch this and say that certainly doesn't affect me. And I think that was the purpose of the people that drafted these proposals. So starting out, there's a new higher income tax bracket, an ordinary income tax bracket. So if we go back in history a couple of years, we'll remember that the 2017 Tax Cuts and Jobs Act reduced multiple tax bracket rates a couple percentage points, including the top rate down to 37%. Well, that's going back to 39.6. That's considered a new bracket for the highest earners. They've also tightened the bracket a little bit. So the people that are going to earn that, or excuse me, pay that, used to have to cross 628,000 for a married couple in 1 year. That number is going to be reduced to 450,000. So not only is this very high income earner going to hit that top bracket sooner than they otherwise would have, the top bracket is now much higher at 39.6%.
So in this case, they're gonna get there sooner, and they're gonna pay more when they get there.
Right, and I don't think too many people watching the video are going to be too mad about that, because it's not affecting the average everyday person. This is for very high earning individuals, but a married set of doctors can easily eclipse this number.
Okay. What about long-term capital gains? There's been a lot of talk about that, obviously, for a couple of years now. What are they doing there?
Right. So again, this is primarily only going to affect the more well-to-do middle class. So previously, the top gain that you would pay on a long-term, the top rate you would pay on a long-term capital gain, that's a security that was held for more than 365 days and sold at a profit. It used to be 20%. They've increased that rate to 25%. I want to point out here that there was a lot of talk around lining up that top long-term capital gain rate with the ordinary income rates, which means someone could, if that had happened, someone could potentially pay 39.6% on the long-term gains. So a little bit of a compromise here. They've landed in the middle at 25 for the highest earners. One interesting piece here, if this bill or if this proposal passes as laid out right here, any gain created from September 14th, 2021 forward will be caught up in this new rate, assuming you've reached the income hurdle. So it's already too late to avoid this new higher rate. It is for higher income people, and I want to point out that that's easy to get caught up in if this is a year where you're potentially selling a business. You could be recognizing a lot of long-term capital gain right there.
Right. And so, it seems like a small amount, 20% to 25%, but that's actually a 25% increase in the tax you might pay at the top rate. Correct?
Correct. And
Okay.
actually, I should point out, I keep saying higher income. This one can be achieved at smaller dollar amounts if you have a lot of ordinary income and then layer a little bit of long-term gain on top of that.
Okay. So another major thing that I see here in my notes, there's some work being done on Roth conversions, and I know not everybody's 100% familiar with what a Roth conversion is. So maybe before we talk about what they're doing there, let's make sure everybody understands what we're talking about with Roth conversions, and then what they're proposing in the bill.
Yeah, thank you. I definitely want to take a moment to lay out different ways to get money into a Roth account. So let's start with reminding us what a Roth is. It's after-tax monies that are in a retirement account. They go in after you've paid tax. They grow tax deferred. And assuming you have a qualified withdrawal later in life, they come out tax-free. So this is very valuable money if you can afford to get it in there. There's a few key ways to get money in there. There's contributions, which are dollars done while you're working into the account. And those are often limited by your income. So if somebody had too high of income, they may not be allowed to put money into a Roth IRA. So there's also conversions, and there's two key types of conversions. One has lovingly been referred to as the backdoor Roth IRA, and I'll just jump ahead and tell you that's being eliminated. That piece is where a higher income earner may be trying to get money into a Roth IRA, even though they're above the contribution limits, and they do that by putting a non-deductible contribution into a regular IRA, then converting it, the after-tax portion, over to Roth. That strategy is eliminated. A sister strategy to that backdoor Roth is also what's referred to as a mega backdoor Roth, which only certain people have access to within their employer retirement plans, typically a 401k. So that individual may contribute money to the account up to the maximum amount, which is $19,500 a year. But then the specific 401k may have the ability to contribute more money past that 19.5 hurdle up to somewhere around 56,000 potentially in after-tax dollars, and then immediately convert it over to Roth dollars within the plan. That has been a great strategy for high income earners, and in this proposal, it's being eliminated. So both
So
of
both of them are proposed. We should really solidify that these are proposals that haven't been passed, but both being eliminated in the proposal. And you know, talk a little bit about how big of an impact that could have on a high earner. I mean, this seems to be a major strategy buster for high income earners.
It definitely is, and understandably, the average taxpaying citizen may not be overly concerned about this being eliminated. But for your higher income earners, again, a great example is a married pair of doctors earning very good money because they spend a good chunk of their life in school. This is going to severely restrict their ability to get money into Roth accounts, which is your most valuable account. It could subject them to much higher taxes in retirement. Initially, it won't affect their tax bill because that money had to pay tax before it went into the Roth anyway. But down in retirement, decades from now, it could have a significant effect on their tax bill. It could be very punitive in that regard, with compound interest and investments quadrupling and septupling over the years. Before we move on, though, I want to make sure we jump into the third type of way to get money into a Roth account. That's a traditional conversion. And in this proposal, those are not being eliminated, although they could be curtailed. So a traditional conversion, we do these for a lot of our clients when they retire, they hit low income tax years, and it may make sense to do conversions of dollars from a pre-tax account. The difference here is that's not an after-tax account, it's a pre-tax account. So money went into a traditional 401k or IRA pre-tax. And then if it makes sense from a tax standpoint, you could take dollars from that pre-tax account, convert them to the Roth, pay the tax on the conversion. That is still allowed, but for higher income earners, and a lot of the higher income earner numbers are tied to 400,000 single, 450 married filing jointly in this proposal. For higher income earners, starting in 2032, it's possible that you won't be able to do a Roth conversion. This still may not affect retirees because their income drops when they retire. But this is just Congress doing their best to limit people's ability to take advantage of these after-tax rulings.
Okay. So there's something in the bill here addressing RMDs, another pain point for retirees, required minimum distribution. So talk about what they're proposing for changes to RMDs and how those work?
Yeah, so initially I'm going to throw some numbers out there and people are going to think that doesn't affect them, but the numbers we're talking about are not adjusted for inflation. So if this law passes and then doesn't get changed or tweaked in coming tax years, it's possible a lot of regular investors, regular retirement savers could eventually bump up against this. What we're talking about, well, at least the account value, there's two pieces here. If someone is considered a high earner, which again is that 400,000 single, 450 married filing jointly, and the cumulative total of all their retirement accounts reaches a value greater than $10 million, the following year they will immediately, regardless of their age, be forced to take an RMD of 50% of the dollar amount over 10 million. So two pieces here. The account has to be, or the accounts total have to be over 10 million, and they have to be a high earner. Again, that married couple of doctors or anybody else in that kind of tax bracket could potentially get there over the decades as their accounts double and triple and quadruple.
Right. And of course, that RMD of 50% over the amount of 10 million would immediately become income and become taxable, which of course has all sorts of other consequences, putting people in different tax brackets and all sorts of other things.
Correct. I should add that theoretically, this could happen to someone who's under the age of 59 and a half. Typically, dollars coming out of a retirement account at that age pay a penalty. This particular RMD will not trigger that 10% penalty. So it's just taxation. There's a further caveat in there for accounts that total over 20 million and add complexity. We're getting out into a part of the world that doesn't affect regular people. You can thank Peter Thiel and that headline winning 5 billion Roth IRA for getting this kind of language included in a tax proposal.
Quick question on this. Does this also apply to inherited IRAs? Or does this apply to that as well?
Great question. So once you own the inherited IRA, it will be added to your cumulative total. So again, that married couple of doctors who have not yet retired, so their earnings may be over 450 married filing jointly, could inherit accounts from wealthy parents, tack that on to the few million that they've saved over decades of working and saving diligently, and suddenly find themselves over 10 million and 450,000 of income and be subject to this.
And in that case, you could be a younger investor, Paul, with let's say you're 35 years old. Your parents had significant wealth. You inherited an IRA that put you over this limit. You have now new rules that require you to take RMDs on that inherited IRA. And if you're over the overall threshold, you're going to have to take the 50% out and pay tax on that within a 10-year period, I think, correct? Or is it immediate?
Immediate. 50% of the value over 10 million. If you inherit 10 million bucks and you had $1 million, you need to take a $500,000 RMD the next year. That'll be taxable income tacked on top of where you're already a high earner, and you will pay an incredible amount of tax at that new top tax rate.
Okay, great. Okay, so there's of course, we could probably spend 3 hours talking about, this proposal. What are some of the other things in there? I know we want to touch on the expanded child tax credit and the extension of that. So maybe talk a little bit about that, and then maybe some of the other quick hitters that are in the proposal that people might want to be aware of or might be interested in.
Yeah, so we'll add, and Mike, you know this. When this passes and becomes law, we'll digest whatever the changes are, and we'll come back with more detailed videos on this. So to keep moving, there's 3 more pieces I want to hit. So one, the unified estate and gift tax exemption, otherwise known as the estate tax exemption. That means when you pass away, what's the value of all your assets, and does the government take a portion of those as a tax? The TCJA passed in 2017, excuse me, increased that number to an inflation adjusted 10 million per person, which for this year is 11,700,000. That was set to sunset in 2025. They are accelerating that sunset and going back to the 5 million inflation adjusted, which means that if an individual was to pass with somewhere around 5.9 million next year, they'd be subject to it, potentially to an estate tax.
Okay.
That does affect better off individuals and will affect estate planning. So I wanted to touch on that.
So that sunset, just to be clear, that sunset would take place at the end of this year if this bill is passed as written.
Correct. The majority of the changes in this proposal take effect starting January 1st, 2022. The long-term capital gain recognition got caught up as September 14th, 2021. So that was one piece that was in the current year.
Gotcha.
So moving on, I want to mention wash sale rules just because to me it's very interesting. A lot of the crypto investors have been touting the potential idea that they could get around wash sale rules. Wash sale is where you recognize a loss on selling a security, and then if you do not wait at least 30 days to buy back that security, you could potentially be disallowed the ability to take that loss on your tax return. Crypto was not included in the language to make it wash sale eligible, which people were loving because they're buying and selling daily. That has been cleaned up. So cryptocurrencies, regular currencies, and commodities will all now be subject to wash sale rules. There's some additional language there that could affect our investors, even if they're not in crypto, around what a related party is to the person that's buying and selling a security. So if your partner buys or sells a security within that 30-day period, you could still get caught up. It's not just your accounts, it's everybody that's related to you, a dependent, etc. And further, and I'm a little unclear on the language here, and we'll wait for clarification when this comes to law. It appears they're changing the time periods that affect a wash sale. It used to be buying or selling 30 days before or after taking that loss. It looks like they're going to extend that potentially to the end of the current tax year. Again, we'll wait for clarification. And Mike, just to keep moving, I want to jump into the third piece here. The expanded child tax credit, huge expansion coming out of the CARES Act in 2021, excuse me. And what that ended up with is them trying to, well, them being Congress, effectively increasing the dollar amount that you could potentially receive for having children on your tax return, anybody under age 18, and even a greater amount if you're under age 6. And to get money in people's pockets prior to April of the following year when they file their tax return, they started paying 50% of the estimated credit in July through the end of December, which is happening right now or in September of 21, to get money into people's pocket. A lot of that is going to continue in 2023. So they're going to do the same thing next year, expanded child tax credit, prepaying starting in July is my understanding from this language.
Monthly, right? Monthly prepayments?
Monthly prepayments starting in July and running through December. Again, this language is proposed and we're going to be looking for clarification on it, assuming it passes. There's a second piece to this. Starting in 2023, they're going to have a formal monthly payment. And my understanding is the entire year, January through December of 2023 and beyond, where you get your estimated child tax credit paid to you in monthly installments. This will help real people pay bills monthly instead of getting a larger return at the end of the tax year where it may not be able to help them as much.
And this is a non-sunsetting proposal, right? This would be in perpetuity.
Correct.
Okay.
That is the way it is being proposed. Last interesting piece on that, the formal changes coming in 2023 on the child tax credit are also drawing up the ability to qualify for that credit based on your current year's income or potentially any of the past 2 years' income. And assuming you didn't fraudulently underreport income to qualify for this, they won't claw it back if you get to the end of the year, they've paid you 12 months of payments and found out that your income ended up being much higher than expected, and you actually owe back this money. They're saying no, unless it was blatant fraud that you underreported your income, you will still get to keep the money that we paid you.
Okay. All right. Well, great. Hopefully we were able to touch on the major points. There's lots of things in this proposal. We could probably talk for a couple of hours on it. So what we're going to do here, at Level is we're going to keep an eye on it, watch it very closely. And as things develop and we get more detail, we'll certainly bring more information, probably more informational videos to our YouTube channel like usual. So until then, I'm Mike Hebron with Level Financial with Paul Coleman, CFP. And until then, thanks for watching.